Okay, go ahead.
Okay, Katishia, thank you so much for doing the second session today from the financial management. Today is the balance sheet. So thank you, Katishia. Take it from there.
Thanks, Emil, and thanks, Common Capital, for hosting this presentation. And thanks, Emil, for all your great work in the with small business owners. I met Emil like a little bit before he came to Common Capital. He was out there fighting and advocating for small business owners, and he still has that heart. So you really have a real one with Emil if you get the opportunity to work with Common Capital and Emil and the team. You really have someone that's really going to fight for you and support you in all the ways possible, not just with the lending, but providing these types of services and these types of information to allow your business to be as sustainable and viable as possible. So, for those who haven't partnered yet with Common Capital, I strongly advocate and advise you to just take a look if you're ever in need. Serving Western Massachusetts, I believe all the 5 counties or so there. And beyond. I know that they won some prizes for being, it says the #1 SBA microlender in Massachusetts. Yeah, so they do great work. So it's a privilege to partner with them and serve their clients as well. Um, so today, this is part two of three-part financial webinar series, Understanding Your Business Numbers. And last time we talked about the profit and loss statement and asked and answered the question, are we profitable? Today, we're going to look at the balance sheet and we're going to ask and answer the question, are we healthy? We're going to learn how to read and understand the balance sheet and really understand what's behind the numbers and how the balance sheet can be used as a tool to understand the overall financial viability of your business. It's probably my favorite financial statement. The profit and loss gets all the fanfare, of course, yeah, because that's very important. It shows money coming in and money going out in terms of profitability. But the balance sheet is a really good, strong metric for financial health. And hopefully, if I do my job right today, I'll kind of show you why that is. So these three sessions asks and answer three questions. Are we profitable was completed, and hopefully you have the recording if you attended that session. Today is Are we healthy? Looking at the balance sheet. And next week we're going to look at Are we sustainable? Looking at the statement of cash flow or the cash flow statement showing the money coming in, money going out, right? Each session is designed to be a standalone session. But you'll get the most bang for your buck by looking at it with all three and seeing the complete financial picture. Questions, comments can be, of course, it doesn't bother me to interrupt, but you can drop it in the chat as we go along if you need some clarification on a particular point. So this session, here is our task for these moments that we have today. We're going to ask we're going to discover what the balance sheet actually shows. We're going to look at the accounting equation and explain that. We have an example company, it's called Bright Path, and we're going to look at their balance sheet and use that as an example to flesh out some numbers and analyze it a bit. But I invite you also, if you have your own balance sheet and you have that ability to print or have access to your balance sheet and financial statements, I invite you to look at your numbers and take the equations and the formulas and the metrics that we give you today and apply it to your own numbers. I dropped a handout in the chat as well. It's just an overview of today, and it also gives a definition of some numbers that we'll be discussing today. So for your future reference, and after this session, the recording and the slides will be available. The fourth point is we're going to look at two diagnostic ratios. And lastly, we're going to spot some warning signs on even if your business is profitable. And I'm going to drop that handout in the chat one more time for those that, oh, that's the wrong one. To those that weren't able to get it the first time. Session 2 handout. There you go. All right. Session 1. I wonder if anyone had any questions or lingering items from the first session. We looked at the profit and loss statement and we tracked revenue all the way through net income. We invited you to look at certain expense items and the concentration of certain costs, as well as we broke out the expenses between cost of goods sold or cost of sales and those other fixed costs or operating costs. And we use those numbers to determine the gross margin, the percentage. So the gross margin is the gross profit. Revenue minus cost of sales is your gross profit, and you take a percentage of that, and that's your gross margin, right? And that shows how efficient you are in making your product or service available for sale. And then the net income margin, or the bottom line after you deduct all those operating costs, is the net income. So that net income, that bottom line that you pay tax on, you take that as a percentage of revenue, and that tells you your net profit margin. So for every dollar that you bring in, say if your net margin, as with BrightPath, is 7%, for every dollar you have retained 7 cents as net profit, right? And we also looked at the break-even point. That shows at one point, what point in your sales you're able to actually start making money, right? What point of your sales could you completely cover your fixed costs and be able from that point to be profitable? And we also lastly talked about the limitations of the income statement. It shows profitability, but it doesn't show cash, and it doesn't show health and sustainability. Those are other statements that we're talking about today and next week. So again, if you had any questions or anything, if you ran your numbers last time and you had any questions that came up from our last session, I invite you to chime in, or you can unmute yourself and talk about it, or drop it in the chat, and we can discuss any questions from our discussion on the profit and loss statement. Continuing on, the example company is BrightPath Consulting. It's owned by Maya Chen. It's an HR consulting firm in Atlanta. She has a staff of 8, 5 consultants, 2 project coordinators, and 1 part-time bookkeeper. Her revenue model is 60% retainers. So those are month-to-month fixed revenue clients that she has as retainers. And then she also has 40% of her revenue model is from one-off project work. This is her 4th year in operation. So she says she's growing. We saw last week, or we saw from our prior session, that she's profitable. Actually, revenue is growing, profit is sustaining, but she says that she still feels tight and she wants to know where her money went. And so today we're going to dive a little bit deeper in that and give a little bit more information about how the balance sheet can answer some of those questions. BrightPath had a good year, so why does it feel tight? These are the numbers that's in last week's handout. I'm not sure if they carried over for this week's handout, but the revenue was 1.2 million. The net income was 7% of that, or 87,400 was left. After she paid all of her expenses from that 1 million revenue she brought in, she was able to still have profit of 87,400. So that showed the money that she made, but what does she own and what does she owe? And today we're going to discover whether she has a strong financial foundation using the balance sheet. Let's hop into it. Here's a snapshot of the balance sheet. It shows the assets. So if you go out and for your business, you acquire some equipment, you acquire computer to work, or equipment to, like, say if you have a t-shirt pressing company and you buy that machine that presses and makes t-shirts. Those are assets, right? Liabilities are what you owe, any loans that you take out for common capital or other lenders. Maybe you take out a line of credit, or maybe you have an account with a vendor and you have some outstanding bills to pay. That's part of your liabilities, as well as credit cards. Yeah, those credit cards and those interest rates are really getting high nowadays, but that's part of your liabilities. That's going to be on your balance sheet. Your profit and loss is not going to tell you that. Your balance sheet is. And balance sheet also tells you equity, what you invested in the business minus what you've taken out, as well as the profit that has been retained in the business. That's equity. That's going to be shown on your balance sheet. It answers the question, are we financially healthy right now? It shows you a snapshot of the business at any given time to shows, I like to say it shows the retained value of the business at a particular time from historical when you started all the way to today. The balance sheet's going to show that picture. And we're going to back that up by some numbers. It won't show you revenue. It won't show you expenses. It won't show you profit. That's the income, the profit statements, profit and loss statements job. Here's a critical distinction. A business can be profitable, but not necessarily healthy. A business can be growing, profitable, and still be financially fragile. Here it is. Here is the account. There is the accounting equation, right? This is the thing that you can take to the next dinner party and wow and razzle dazzle of someone in small talk conversation. You can say, hey, listen, I know the accounting equation. The accounting equation is assets equals liabilities plus equity. And why I kind of geek out on that and say that that is a huge flex is because this is the equation that is used from the Fortune 500, 100 companies, all the way to the mom and pop, all the way to the nonprofit, all the way to the ministry. This is the financial equation that is behind every business. Assets, the value of your assets equals liabilities plus equity. It is a universal equation that is used. So you can be able to go online right now and get Apple's most recent financial statement, flip to their balance sheet, and they will be using this equation. You'll see what their assets are, you'll see what they owe as far as liabilities, and you'll see the stock, their stock equity that people, if you or I or anyone that owns part of Apple stock, we're part of the equity section of their balance sheet. Assets, again, shows cash, receivables, equipment, prepaid expenses. Assets could be any real estate property, any capital improvement or leasehold improvement. Say if you are leasing out a brick and mortar facility and you have to kind of ramp it up and fit it out for your particular business, that's called a leasehold improvement. That's an investment and that's an asset that goes on the balance sheet. Liabilities, we talked about that. Bills, loans, credit lines, accrued payroll, that's a liability. And equity is, you would like to think it's a leftover, but it's kind of, yeah, the accrued net worth is what I would like to say it is. I'll pause for any questions. All right, cool. Remember that equation, asset equals liabilities plus equity. We're going to use that. Now, here's BrightPath's assets. You'll see it in the handout, and we're breaking it out piece by piece here on the slides. Starting with the current assets. Now, does anybody know the difference between current and long-term assets? What is the distinction there? Does anybody know that?
Our current things that you have now, so and that you won't have later, like for example, maybe office supplies, things like that. And then what'd you say, long-term assets?
Yeah.
It's more like furniture possibly or real estate. Is that right?
I love it. Yeah, yeah, you're dead on. You're dead on. And the accountants are a bit more precise about that. We say current assets is anything that converts into cash within the year. So it's going to be the cash, it's going to be your CDs, it's going to be your investments, it's going to be your accounts receivable, it's going to be the prepaid expenses. Anything that you can quickly convert into cash or liquid within a year right now, like the participant said, is it Zeta?
Yes.
Yeah. All right. I think I know you. Yeah. All right. I've seen you in circles. All right. So yeah. So that's within this year. That's can be converted into cash, right? So that's current assets. And for this company, Bright Path, current assets total 157,000. 34,000 of that is cash. And we see from year to year, from year 3 to year 4, it actually decreased. The balance at the end of year 3 decreased from 48 And then now at the end of year four, it's 34,000 and went down, right? Despite revenue going up, right? Her cash balance is decreased. Accounts receivable. Now, this is accounts receivable that you billed, that you earned, but the customer hasn't paid for yet. You've invoiced this, you've done the work, you should have it, you report it as revenue if you're on the accrual method of accounting, but you haven't yet received it yet. And so her accounts receivable is from 74,000, went from 74.8 in year three. And now at year four, it increased to $118,200. So the majority of her current assets, another way of saying current assets is our liquid assets, those assets that can quickly convert within a year to cash. The majority of it is accounts receivable. It's customers that she has done work for, but haven't paid her yet. And we talked about it last week a little bit when you're in like this service industry. I don't know how many of your businesses or organizations lend themselves to be in a position where you invoice and you invoice for work that you haven't gotten paid for yet, but that's on your balance sheet, right? And so it could put you in a precarious situation, particularly like if you do work with government, they're notorious, right? They're going to pay you 60, 90 days, however many days. You're not going to get that money right away, but you have expended the cost of providing that service already, right? And you have this huge accounts receivable. I serve clients that work in the healthcare industry as well and bill like health insurance companies. That's another one. You've done the work, but you may not get paid 30, 60, or just 30 or 60 days um, from now, right? So you have this large accounts receivable balance that makes you not as liquid as you could be. So in essence, like the owner here of Bright Path, she's basically kind of financing her customers at any given time. Her customers are owing her a great majority of the money, the revenue that she has booked, right? So then you can understand how that may lead to a situation why things can be tight because you've incurred the costs to provide the service, but you're not yet paid. So those are current assets, right? Here's a question, and I'd be open to y'all's participation. What might explain receivables growing so much faster than revenue? So revenue is growing, and it is increasing from year to year. She's made $1.2 million, but the receivables continue to grow, like her customers still owe her. What do you think is behind that? Put on your CFO hat and your analytical hat. What do you think is behind that increasing balance in accounts receivable?
Is it money that they were owed, got paid,
Mhm.
basically?
Exactly right. Yeah, money is that is owed that's not yet paid. So it could be most likely in her terms, right? I think last week we may have talked about maybe accepting a deposit up front before you even do the work, right? Or for her, it might be in her payment terms. So she may invoice and say, hey, you're net 30 or net 60 days, right? So I'm doing the work, but I'm not getting paid till 60 days. So yeah, great. You're right on point. That's exactly right. Non-current asset, has been mentioned, are those assets that hang out in the business a little bit longer than a year. They have a useful life that extend beyond a year. So those are things, investments that you have purchased for equipment, and it is depreciated. So a portion of that cost is taken as a deduction each year. That's the nature of this accumulated depreciation. That's an accounting equation, an accounting term, accounting formula. So whatever the gross cost is for that asset, a portion of that will be deducted each year. And so we see with BrightPath, she had purchased because equipment increased from 38.6 up to 52.4. So there was investment in some equipment, right? And so we have to find out, how did she finance that? Because we already see revenue grew, but her cash still seems a little bit tight. Her cash is actually low. That's assets. So the total asset, let me go back. Remember accounting equation, total assets is going to be total liabilities plus equity. So her total assets is $189,600. All right, so let's remember that and let's move forward. Now let's look at liabilities. And here we are with current liabilities. Similar to current assets, those are going to be the liabilities that are due within 1 year. So all of this 56,400 are liabilities that she's going to have to pay within the year. And we see of that current assets, 11,200 is accounts payable. So that's vendors that she actually owes. And then there's accrued payroll. So there's payroll that hasn't yet been paid yet. That's 14,800. And then we see in year four, the credit line payable went from 0 to 22,000. So she had to go out and get a line of credit, right? And so a line of credit, does anyone know what the difference between a loan and a line of credit is? Anybody have any guesses, or do you know what the difference between a loan and a line of credit is? Oh, cool. All right, so let's learn. All right, go ahead, Emil. Go ahead. Unmute.
So the loan is an installment loan that you get a 50,000 loan. The term is 6 years. You will pay every month till you paid off. The line of credit, if you ask for 50,000, you will take some of this 50,000, pay interest for this 25. Let's say you took, return it, pay it back. You don't pay interest, so you still have this room whenever you need it. So usually the construction company, when when they need equipment, they will, or when they need materials, they used to get a line of credit, some cash flow. I think also it's useful. Let's say payroll, they will borrow this much to cover this payroll, and then they pay it back, and when the interest pay them back. So kind of save in the interest, if that kind of business.
Perfect. Yeah, great. So yeah, like Emil said, the loan is actually an installment loan. So you have fixed payments every month for 4, 5, 6, 7 years, right? The line of credit is money that you draw on, but you only pay the interest on right now until you can pay down the principal portion of that line of credit, right? And depending on the lending institutions, they may have an option where you convert that into an installment loan. But for right now, you can use for instance, may have used this line of credit, this 22,000 to cover payroll or to cover those short-term cash flow gaps that she had. So we see, even though revenue grew, so look at the picture, the dichotomy of it. So revenue grew. She's a $1.2 million business. So the revenue grew, but she still had to draw on this line of credit to fill in that cash crunch. We also saw that the equipment grew, but she had to take out a loan to finance that. So of that equipment loan, 8,400 of that is due within the year. That's the current portion of the equipment loan, and the long-term portion of the equipment loan that has payments date beyond this current year or 1 year is 15,400. So her total equipment loan is 23,800, and her current line of credit right now drawn is 22,000. So her liabilities grew from 21,000 to over 71,000. So that's over 3 times, right? A 242% increase. So then we now begin to flesh out that picture and understand why things are starting to be so tight now, because she had to pull on this line of credit. She had to get some loans, which now is some payments that have to be paid. The interest of those payments is going to be in the profit and loss, but the principal portion is on the balance sheet. So the profit and loss is not going to show you the complete cash outflow of those payments. So now we're starting to flesh out this economic picture a bit here. Let's go a little bit deeper. Unless you have any questions, you can interrupt at any time. So, so we're starting to see a margin picture again. We're seeing the cash is a bit thin. We're seeing her receivables are super high. They're 118,000, right? That's almost like 10% of revenue, right? We're starting to see that she had to utilize or draw on her cash line of credit. And then we also see that she took out a new equipment loan, right? So this is now showing a more detailed picture of of her business or overall financial viability um, in addition to what is shown on the profit and loss statement. Profit and loss shows very profitable. Balance sheet shows a little bit more of some warning signs. So we talked about the liabilities on the balance sheet. Now the equity. Of the equity, there's owner's contributions. That's money that she personally invested in the business. So $30,000 of her own money was invested to get the business going right now. And then retained earnings, right? Sometimes on the balance sheet that's broken out. You'll see the net income that was brought in from the prior years, and you'll see owner's draw as part of that as well, right? So right now, this retained earnings went from 101 to 87.8. But if we remember at the end of year three, she had net income of 87.8. All right, so here we go. Let's slow down just a bit. So if we're looking about how did the retained earnings go from 101 to 87.8, right? Here's the equation. We start with beginning retained earnings of 101, and then year three net income was 87,800. Oh, no, 87,400, right? So 101 plus 87.4. And then if we reduce that by the ending retained earnings of 87.8, let's do that math really quickly. We're starting with beginning retained earnings of 101,000. We're going to add in the net income from the prior year, which is not here, but it's given it to you. It's 87,400, right? And then we're going to subtract out this ending retained earnings balance of 87,800. That gives us a difference of $100,600. $100,600. Do you know what that number represents? Would anybody be willing to take a guess?
No.
No? All right. NO. Let me tell you what that number represents. That number is her owner's draw. So as an LLC owner or a sole proprietor, the money that you take out as an owner is not going to be on your profit and loss statement, right? Unless you're an employee, which is an S corp, you're an S corp and you're a wage earner. But if you're an LLC and you're taking an owner's draw, that's going to be on your balance sheet. So beginning retained earnings, then we have profit that we add to that. And then when we subtract out what she drew out $100,000. Then that to pay herself, which, hey, she earned it, right? Is growing. She's growing the business, so she earned it, right? But that shows us that her retained earnings at the end of the year is now at 87.8. Questions about that? Comments? Why does that, how does that sit with y'all? Does that make sense on what you have seen in your own numbers? Can you flesh that number out? Make sense? So your owner's draw is not going to be on your profit and loss statement. Your owner's draw is going to be on your balance sheet.
It does make sense more or less. However, I guess in my instance and maybe other people's is that the business is so new that well, there isn't such real thing for me as an owner's withdrawal because of expenses and the newness, within the first year.
I hear you and I feel you. Yeah, that's
So,
something that I'm extremely passionate about. I'm sorry, did I cut you off? You have something else?
oh no, I guess my ending point there is that this is something to look forward to. So in theory, I get it, and I think that maybe other people are maybe in the same boat.
I hear you. Anybody else feel
Yeah,
thoughts to understand
yeah,
what he's saying?
Mark here. Is that over 2 years rather than over 1 year?
Good question. No, that's over 1 year. So that's the
Okay,
difference between year three and year four. Yep.
okay.
But this is a cumulative number over
Yeah.
all 4 years. Yeah. Good question, though. Yep. Yeah, I mean, I hear you and I feel you, like I said. And so that's the reason why with these metrics and this knowledge that we're getting here, as well as what you're getting from other inputs and your own expertise in growing your business, you'll start to know at one point, hey, when can I start paying myself? And I'm a, profit first certified professional, and we're really, really big on getting to the point where you can pay yourself. Profit first. It's talking about learning, designating money to pay yourself first. And what would it take in order to do that? Last week when we talked about the break-even point, that helps you to know when the business is profitable. But then also as part of that equation, start to build in, hey, at what point can I start paying myself? Because if you're not paying yourself, then you are truly like funding your business. And I understand that. We've all done it. Like those of us that are bootstrapped and like kind of grown our business from the ground up. But if you really want to scale and grow, you have to start running those numbers and seeing at what revenue point can I, so what are my revenue goals? All right, then what are my cost of goods sold? So what would it cost to get that in? And then what are my fixed costs, right, to operate the business? And then based on that, now at what point can I start building in something to start paying myself and how frequently, right? So usually when this kind of probably beyond the scope, but just kind of free for coming. Like when I start to talk to business owners, it's like, all right, what do you realistically want to draw from the business to support your lifestyle? And then we reverse engineer that and begin to think about, all right, then what are your revenue goals? And then what would it take to get to the revenue goals? Like, how does your market sustain that? Are you going to raise your price, lower your price? How are you going to get there? What is that cost of goods sold? And what is the profit margin for all of that? So those are the things and numbers that you could start to think about as you begin to understand your financial statements a little bit more and your um, current financial biz position in terms of what it costs you to produce your product, right? Or offer your service. And then what are the fixed costs, those costs that are going to linger around whether you make a sale or not? And how can you maybe lower those or get those as tight and lean as possible in order to start thinking about what it would take to pay yourself? So here's that equation check again. Total assets, hopefully you remember that number. It was 189.6. Her liabilities is 71.8 and equity is 117.8. So that's how that shows the balance there. Here are two metrics for today. Hopefully not confusing you or complicating things just a little bit more, but I want to go just a little bit deeper if you have your balance sheet, just so you can kind of tease out some metrics there that you can use to determine your own financial health or the organization's financial health. Two of them are current ratio and cash ratio. Current ratio is taking those current assets and dividing them by the current liabilities. So the current assets, those things that are due within 1 year, dividing it by what do you have to pay others within 1 year. And so for BrightPath, current assets is 157.2 divided by current assets 56,004. That ratio gives us 2.79, which is excellent. It's above 1.0, which is kind of a baseline, right? And above 2, which is like really just like excellent. She's almost at a 3. So basically that's saying she has almost 3 times as much current assets in order to cover the current liabilities and obligations. Within a year, if those 1 year obligations become due on demand and she had to pay those right now, she has over $157,000 worth of assets that she can convert into cash and pay them right away. Make sense? I'll pause. All right. That's the current ratio. That's current assets divided by current liabilities. But that metric looks great for her. Let's dig a little bit deeper because if we remember, her accounts receivable was the largest part of her balance sheet in terms of current assets. So most of her current assets is money that her customers owe her. So she doesn't actually have that in the bank yet. Right? So most of her current assets is tied up with somebody else's pocket. She'd have to get that, right? But so if we nail down and get a finer point to that and just look at cash in the bank and divide that by current liabilities, then we see a tighter position because she only has $34,000 in the bank in terms of cash, and her current liabilities are still 56.4. So if that $56,000 became due on demand right now, she only has $34,000 in the bank in order to pay it. So that shows a bit of a tighter position. She can only cover about 61%. That's what this ratio means. Around 61% of her current liabilities she can only cover with cash. The rest is accounts receivable that she doesn't even have access to yet. Make sense? And does that help understand how the balance sheet can be used as a metric to determine financial health and to make some decisions there? I'll pause because I know it might be a newer concept. And this all may be contingent upon what you have in your QuickBooks or Wave. So if you have a cash business, or if you have a business that doesn't lend itself to invoicing, or you haven't input those invoices in your accounting system, you may not visibly see your current assets. You may not know how much accounts receivable is out there. So you might have to do paper and pen type of equation to get there.
I'm sorry, how does QuickBooks determine that?
Yeah. Oh, I wonder. Oh, that's a great question. I love to get into trouble. So let's see if I can get into a little bit of trouble and see if I can look up a QuickBooks. QuickBooks has a demo account out there. Let me see if I can find it. But basically, you're gonna have to input all your invoices in QuickBooks to um, in order for them to know that, right? And then there is a report that you can run that, oh man, they no longer give you access to that. I thought they give you access to a demo account. Oh man. They used to give you access to a demo account.
And I only asked that because so like in my business, it's a insurance reimbursement business. So I'm, billing insurance companies, and one of these days we'll get paid.
Okay, so you knew exactly what I was talking about then.
Yeah.
Yeah.
So I don't
So
know.
if so the only way QuickBooks would know that is if you have manually input those invoices in QuickBooks, or you had an integration where your insurance company speaks to QuickBooks and automatically downloads those invoices into QuickBooks. So QuickBooks has integration with certain point of sale systems with like Square and like PayPal and all of that, and Shopify. So they have a way to sometimes get that back in information. But if you are billing insurance companies, QuickBooks is not going to know that unless you manually input that information in there. And if you do have that information, you usually run what's called an accounts receivable aging report. An
Mhm.
accounts receivable aging report will show all the invoices that you have outstanding at any given time.
Mm-hmm.
Yeah.
Okay.
Make
Yeah, this
sense?
is all too confusing to me. Yeah, it
I'm
does.
s- I'm
That's
sorry.
okay. It's not your fault. It's
I
not.
didn't mean.
I'm a therapist, not an accountant.
Oh yeah, I hear
That's
you.
why I'm here. That's why I'm here.
Yeah, so for instance, if you were looking at, this is not your portal, but say you were looking at your portal and is it like a ERM or ER something system that you all use?
EMR.
Say it again?
EMR, electronic medical record.
Right. So if you use an EMR system, and it'll show you like how many
Mm-hmm.
uh invoices are due, or what's due within 30 days and 30 to
Right.
60 days, and that's essentially your accounts receivable.
Mm,
So you can use that as your accounts receivable balance.
okay.
Does that
Yeah,
make
because I don't think
sense?
I have, it does make sense, but I don't think I have like accounts receivable in my QuickBooks.
No, you
That
won't have it. So you would have to use both.
enter
So
it
you have to
manually.
use, yeah, you
Okay.
would have to use your EMR system for accounts receivable, and then use QuickBooks for the other numbers,
Okay.
the
Thank
liability.
you.
Yeah, great question though, and I'm glad we were able to dive into that a little bit. Yeah, so this is the accounts receivable aging for this business. And we'll see like $30,000 is due within 30 days. Within 60 days is 41,000, and within 90 days is 24,000. So if you're whatever your system looks like, you will want to see your aging of who owes you within 30 days, who owes you within 60 days, and who owes you within 90 days or 90 plus days. And if you have someone that owes you more than 90 plus days, then you have to start thinking about how we're going to start collecting. Is that something that you have to write off as uncollectible? Or is there something that you can do to talk to them and see if you when and if you're going to get paid, right?
Question, Katisha. If
Sure.
uh, for someone who, let's say, this is a system that for the medical report or for the medical provider, they have this system. But if someone they don't have this system to track their invoices, unpaid invoices, how they will report it to QuickBooks so they can generate a accurate balance sheet.
I knew you were going there. I knew you were because that's a great point. Because like say if like your financial institution is going to want your profit and loss and balance sheet, that's only going to tell you what's actually in QuickBooks. It's only going to be part of the story if your accounts receivable is somewhere else or if your bills are somewhere else. So you have to have a way to, if you're not going to manually put that in QuickBooks, then you're going to have a way to show what to fill out the picture. Hey, these are the bills that I have, the invoices that I have that are coming in due that are not here yet, but they should be due, and these are the bills that I have to pay. Right. So either you have to manually you if it's not if you don't have an integration within QuickBooks, you're going to have to manually add those invoices and manually add those bills to give a
Mhm.
complete balance sheet with a complete picture.
But I know QuickBook has the ability to generate invoices. Say if I have this subscription that I can, because as well, when you set up your QuickBook, you can choose and pick what subscription that you want. So if you invoice people and you want to keep your current, so I think you need to pick the invoices. So you will all your invoices will be in your QuickBook. If it is paid, it's shown. If not, as well, it's shown. That's right.
Yeah, absolutely.
Okay,
And I
great.
wish QuickBooks still had that demo account into it. I have, I'm not going, that's a different conversation. But there is a way within QuickBooks, say if you have a bill, right, that you have from an outside vendor, QuickBooks has a way for you to copy paste that within QuickBooks, and QuickBooks will read the data and be able to import it in so it'll be part of your books. So it may not be as hard as you think, right? You may need is a PDF copy of your invoices or your bills, and you can copy paste that within QuickBooks, and so that'll allow for QuickBooks to have a more complete picture. So it takes a little bit more work, and if you ever had the question one-on-one, if we want a workshop after with anybody that has that particular instance, you can manually import those PDF versions of your invoices or your bills within the system so that QuickBooks can give you a complete picture of what your balance sheet should be. So there is a way. It takes a little bit more work, but it can be done. But if you have your invoice, you can invoice through QuickBooks. You can invoice through Wave. You can invoice through Zero, and that way, all of that information is already in the system, and you don't have to do no manual. You don't have to do any manual transactions. So it's more so you're able to get a more complete picture the more that you put within your accounting software. Any other questions? Great, great. I love it. I love it. So when we begin to look at the balance sheet, we see that the equity fell and the liabilities grew. So then we're starting to see now a little bit of why she came to us feeling like that tight picture, that tight feeling with cash flow. And it shows that these are some indicators of some decreased financial resilience, even though she's profitable. But the balance sheets show that there's strain and some stress points. So to summarize, like her revenue was up, that's a positive, 12%. Her net income was up 12%. Great, right? But then we begin to look at this balance sheet. Here's some items to watch for. Her cash was fell. So now we're analyzing, right? We're putting on that CFO hat. It's a bit deep, and I hope I'm not losing anybody, but you can get the recording and the slides. And if you have any questions, I'm free by email, right? Or bring them next week, right? When you look on the balance sheet, the cash is falling, the receivables is going up. So her money is in other people's hands. They haven't paid her yet. She's earned it, but she hasn't been paid yet. Also, she began to draw on this credit line and add new debt. So that's more cash flow payments that have to be expended each month. And then we also saw as a net value that her equity is declining despite having a profitable year. So these are some indicators of why she's feeling that crunch. Questions, comments? We're winding down. We were going to give you time to do this on your own, but maybe as a homework assignment, as a homework assignment, see if you can pull your balance sheet, find that cash balance. If you don't have accounts receivable balance in your account system, maybe begin to look at who owes you. Take out a list of the invoices and look at the terms and look at accounts receivable aging between 30, 60, 90, and 90 plus days. And take a look at that. Get that information. Get a fuller picture of who owes you, right? Look at your liabilities on your balance sheet and then calculate these two ratios, the current ratio and the cash ratio. And that shows you a little more metric of the numbers that we kind of use in the accounting world, but now you can use it, right? To see how things are for your business. Okay. Here's your opportunity for questions, and here's the summary. We looked at that accounting equation. Remember, that's the place where we're going to flex in these cocktail parties. We're going to say, hey, listen, do you know the accounting equation? It's assets equals liabilities plus equity. And I can pull out Apple's balance sheet right now, and I can show you what their assets are, liabilities, and equity, right? That's the accounting equation. So not only for the big guys, but for you as well. That's the equation that's behind the financial viability of your business in the balance sheet. We learned how to identify asset versus liability and distinguish between current, which is due within a year or can be converted within a year, versus non-current. That's more than a year. Assets that are depreciated for more than a year, as well as liabilities that's due beyond the current year. That was point number 2. Point number 3 is that current ratio. That's looking at current liabilities divided by current assets. A 1.0 is great, is good. 2.0 is excellent, right? Cash ratio is now going to show just divide cash in the bank divided by those current liabilities. If those liabilities that's due within a year become on demand, how are you going to pay that? Will you pay that with cash, or do you have to, liquidate some of the other assets in order to pay that? Number 4, we looked at some warning signs, kind of look from year to year what your balance sheet is doing and recognize early indicators of stress. We got into paying yourself and equity. At what point we see what you're investing in the business, at what point can now the business start paying you as terms of an owner's draw? We didn't even talk about you loaning the business money. So that could be a thing. You can loan the business money and the business can pay you back with interest when they become profitable. And then we learned to differentiate profitability from health. So the business that we're talking about is $80,000 profit every year. But when we look on our balance sheet, we see why things are a little more tight. Here are these metrics in one snapshot. Gross profit margin is the percentage of cost of goods, revenue minus cost of goods sold is gross profit. Take that as a percentage of revenue. That's your margin. Bottom line, your net profit after you pay all your expenses, take that as a percentage of revenue. That's your net profit margin. These are from this top row is from last week. We talked about the break-even point, which is the fixed cost divided by this number that you computed over here, your gross profit margin. That tells you at one point you become profitable and can start making money, have to start paying taxes, but also can start paying yourself. And today is these ratios that are from the balance sheet. Current ratio and cash ratio. These are the 5 KPIs for financial health that we've discussed so far within 2 sessions. Questions, comments, concerns, headache? How are you feeling? I should have checked in. How's everybody feeling? We have a therapist on the call. We might have to do a session. I think we might have to do a session. I think we might have to do a session. How's everybody feeling? We feeling all right? We know who to go to if we need help, right? We feeling good?
What's your number, Katishia? I need to hire you to take care of my books. That's it.
At least now when you come to me, you say, hey, listen, I need to compute my gross profit margin. And we're talking the same language, right? I can understand you however language you're talking, but definitely. So I wasn't they're stressed, but motivated. Yes, that's what I love. That's what I love. That's what I love. Make sure when you're sitting down and doing this, make sure that you've already taken care of your self-care needs. You're feeling pretty good. You've had a good day. You've been out of the sun. You've got some vitamin D. You get just your tea if you drink it or whatever you drink. You're nice in a nice, calm place. You've taken care of you. Now you're looking at the financial numbers. If this is not your thing, make sure you prioritize self-care because this stuff is not everybody. I love this stuff. I could talk about it all day long, but I understand that this may not be as comfortable, right, to everyone else. All right, so that's so far. Next time we're going to talk about statement of cash flow. And we're going to get into a little bit more information on, we're going to answer the question, are we sustainable? We talked about, are we profitable? Today is, are we healthy? Next week is, are we sustainable? Right? So thank you all for your attention. Emil, I'll put it back in your hands.
Thank you so much, Katishia. That is very informative. Also, it is kind of intimidating, but that's something, as long as you want to jump in your business and take this journey, financial is your goal. Just understand them. You don't need to be professional in number, but just understand where you are, taking closer attention to the numbers, what's coming in, what's going out. I think maybe the equation it's confusion, but at least we are always aware or on top of our books, keep accurate bookkeeping, whatever way you want to use, accounting software or pen and paper or Excel sheet, everything should be, at least there's something. Bank statement as well is useful. But thank you, Katishia, so much. Thank you, everyone, for attending. And I encourage you all to come next week as well, because you will have the full package. And as well as I will continue sending the recording of each session with the materials. And if you have any question, reach out to me, as well as Katishia is there, her email as well. Whenever I copy you guys, I copy her email. Feel free, if you are our borrower, common capital borrower, reach out to me. You can have a one-on-one sessions, not one session, sessions with Katishia to help you more and more. Thank you so much. I will stop
Yep.
recording.
If anybody wants to hang over, you have any last questions, I'll be willing to hang